Hello, I hope you are doing well. My name is Jacqueline Vino from Galossa Learning Solutions, and welcome to this Nano recording. Today, we are going to discuss ASU 2025-08, and it has to do with, you guessed it, CECL. CECL really is just the gift that keeps on giving. What we are going to discuss today is some history and some background information behind this ASU to really set the stage, as well as some of the updates and amendments so we can be prepared for what's ahead. With that being said, let's go ahead and get started. So just some background information here. On November 12th of 2025, the FASB issued ASU 2025-08, which amends the guidance in ASC Topic 326 on the accounting for purchased loans. Why did the FASB decide to issue this ASU? Well, as part of the post-implementation review of CECL, since CECL has now been effective, stakeholders in the profession said that they were really concerned about the accounting, specifically for acquired financial assets and how CECL is impacting the measurement of those items. Now, what they noticed was some diversity in practice and some complexity. And the reason why is that there's actually two categories of purchase loans, and those two categories are actually accounted for in two different ways. We have the PCD loans, or loans that are purchased with credit deterioration, that are accounted for in one method. And then we have the regular non-PCD loans that don't have any credit deterioration, and those are accounted for in a completely different way. So we had some diversity in practice, some concerns about this, so the FASB decided to take this up as a project to hopefully reduce complexity going forward. So, first and foremost, what is a purchased loan? These are basically existing debt obligations that are bought by a financial institution from the original lender, typically including a multitude of different things, whether it's things like residential mortgages, it could be commercial real estate loans, could be auto loans, could be student loans, even credit card receivables potentially. These loans are frequently bought in bulk by banks or investors to manage risk, increase liquidity, or potentially expand their portfolios. Now, what is the difference between a PCD asset versus a non-PCD asset? So a PCD asset is when the purchase loan is acquired at a steep discount due to what they call a more than insignificant decline in credit quality since their loan's origination. So examples of this could be, maybe we have a very delinquent loan. Maybe we have a non-accrual loan potentially. Maybe the loan has been downgraded significantly. Maybe we have some impaired loans. So these are loans that basically did not go so smoothly. Now, under current GAAP, if a financial asset acquired has a more than insignificant deterioration of credit quality since its origination and it fits into that category of a PCD asset, it is accounted for under GAAP using the gross up approach. So how the gross up approach works is basically when we have a financial institution or somebody purchases these delinquent loans or these downgraded loans, they basically calculate and estimate the allowance for credit losses, and they add that to the purchase price, and that is known as the gross up method. And accordingly, at acquisition, the entity adds the expected credit loss to the purchase price to arrive at the amortized cost basis that is needed to adopt CECL. And it does actually not recognize any provision for the credit loss expense. So that means the allowance is not recognized as an expense in the income statement on day one. So it does not actually impact the P&L right away. Now, what happens on the other hand if we have a non-PCD asset? So if a financial asset acquired does not have that more than insignificant deterioration of credit quality, the allowance for credit loss is recognized with a corresponding charge to credit loss expense on the income statement. So under CECL, entities accounted for non-PCD assets in a similar manner to originated assets upon acquisition, which means that they did record credit losses through a provision of credit loss expense on the income statement. So at a very high level, right, we have these two different types of assets. They're accounted for in two different ways. What is the difference here? So the amortized cost of a PCD asset under the gross up method is going to be the purchase price of that loan plus the estimated allowance for credit losses, and it does not have that day one impact on the P&L. And then on the other hand, the non-PCD assets use their fair value as the amortized cost, and an expense is recognized on the P&L on day one. So that means that we have very different accounting treatments depending on which category you actually fall into here. So, as you can imagine, this created some issues. Investors and preparers noted that having these two different acquisition approaches creates a lot of unnecessary complexity, and it also reduces comparability. So, additionally, the identification of, do we have a PCD asset versus do we, have a non-PCD asset? That is something that can be very subjective. It can be a little difficult to understand, and it's also not applied consistently from entity to entity. And in addition, investors observed specifically that the non PCD approach does not actually reflect the economics of the acquired financial assets that are recorded at fair value, because recognizing an allowance for credit loss through credit loss expenses results in a double counting, essentially, of the expected credit losses already considered in the fair value measurement. And right, that makes a good bit of sense. If we already are recording this thing at fair value up front, then why do we need to then also recognize an expense on the income statement, right? Does it make a whole lot of sense? The majority of stakeholders really supported guidance that would just better reflect the economics of the acquired assets by accounting for most acquired financial assets under the gross up approach. So people really liked the gross up approach as opposed to trying to do the fair value. And in essence, stakeholders were really in favor of expanding and broadening the gross up approach to the non-PCD asset category. So who does this impact? Basically, every different type of organization with these types of purchase loans. So whether we are a public company, a private company, or a nonprofit organization. However, I will say that in practice, probably mostly the financial institutions have these types of purchase loans. We are probably going to see the most impact on that front. However, though, CECL applies to all different types of organizations. So all different types of organizations are within scope of this standard. The criteria primarily being, do you have these types of purchase loans? And now, probably most importantly, what are some of the updates from ASU 2025-08? What are some of the changes that we can expect to see? First and foremost, it expands and it broadens the population of acquired financial assets subject to the gross up approach in topic 326. So now what they're saying is loans, excluding credit cards, do you want to make that very clear? Credit cards are not within scope of this, acquired without credit deterioration, are going to be deemed seasoned and are now called seasoned purchase loans and are accounted for using the gross up approach at acquisition. So after an organization goes through and they determine, okay, is this a PCD loan or is this a non-PCD loan? Based on that credit deterioration that is expected, we should apply the guidance now to figure out whether or not it is seasoned or not. So, right, if we have a PCD loan, that is automatically going to use the gross up approach. If we have a non-PCD loan, now we have to decide, okay, well, is this a seasoned loan? And can we actually do the gross up approach or not? So there are a couple that are automatically going to be deemed seasoned. All non-PCD loans, excluding the credit cards, that are acquired in a business combination are going to be deemed seasoned, right? So if we got these loans due to a combination that we were involved in, those are automatically going to be seasoned for us, and we can use the gross up approach. Other non-PCD loans, once again, excluding credit cards, are seasoned if they were purchased at least 90 days after origination and the acquirer was not involved at all in the origination of the loans. So once again, under this ASU, entities must account for the acquired loans that meet certain criteria at acquisition, right? Determining whether they are a purchase seasoned loan or not. And then they can be recognized using that gross up approach. So once again, taking our purchase price plus our allowance for expected credit losses. So hopefully this will better reflect the economics of these purchased loans and also reduce some diversity in practice that was being seen. So we're going to expand the gross up method to additional seasoned purchased loans. So when is the effective date for this ASU? It's going to apply to all different types of entities, regardless of whether they are public, private, or nonprofit, for annual reporting periods beginning after December 15th of 2026 and interim reporting periods within those annual reporting periods. Now, the amendments in this update should be applied prospectively to loans that are acquired on or after the initial application date. Also, early adoption is permitted in an interim or annual reporting period in which financial statements have not yet been made issued or available for issuance. And if the entity adopts these amendments in an interim reporting period, it should apply the amendments as of the beginning of that interim reporting period or the beginning of the annual reporting period that includes that interim reporting period, right? So just the effective date here so we can all know when these changes can expect to happen. And that is all we have for today, folks. So if staying up to date with the FASB is part of your job, consider taking our FASB update course that has all of the recently issued ASUs from the FASB. We also cover exposure drafts and ASUs that are recently effective. Additionally, if you're interested in taking CPE from GLS, we also included another QR code for you here. We have lots of different courses in accounting, auditing, government and nonprofit, A&A if you need to have your Yellow Book requirements met, as well as professional development and audit staff level training courses. In addition to our live courses, we also have our webinars and our LC Vista for the on-demand courses. Once again, my name is Jacqueline Vino from Golosso Learning Solutions. Thank you so much for tuning in and taking this Nano course, and I hope you have a wonderful rest of your day. Thank you again.